Hey everyone, it's Thursday morning, 7 o'clock Pacific time, and that means we are bringing back our friend of the channel, Jonathan Twomley. How you doing, sir?
I'm great. How are you, Michael?
I'm doing very well. It sounds like you've got some interesting data you collected this morning, some analytics about the multifamily space. I thought we'd maybe start there, and yeah, we'll just start there.
Yeah, so there's a couple of interesting articles that popped into my inbox this morning from uh, Real Capital Analytics, which is a big real estate research firm, and they research all the food groups, but obviously they do apartments, and obviously they are institutional focused, so they're not. So what they focus on is a little bit different than sort of what your typical retail investor or syndicator is focused on, but it's still helpful data to be unpacking. And so the first thing I thought was interesting that was sent out this morning was a snapshot of deal flow uh,
Mhm.
for the first 11 weeks of the year. So that's through the end of March,
Okay.
basically, right? So
Yep.
really before the COVID crisis got really going, before we saw a lot of shutdowns and stuff
Mhm.
across the United States. But what's interesting about this data is that it has data for the Americas, for Europe, and for Asia Pacific.
Mm.
And comparing the deal flow, or these are closed deals, I guess, so transactions
Okay.
from the last 2 years. Actually, I wonder if I can share my screen. It'll probably be helpful to show people this data.
Yep. You should be able
Um,
to, I think.
so yeah, just give me a second as I figure that out. Okay, so I'm going to share my screen. All right, here we go. All right, come on. Okay, can you see my screen now?
I can. Oh, look at that.
Okay, cool. Yeah. So this is the first thing I wanted to focus on is this data. So what you see through the first 11 weeks of the year for 2020 in the Americas is that, so this orange line represents 2020. This light blue line is last year, and
Mhm.
this dark blue line is 2 years ago.
Okay.
So what you see is actually last year transactions were down by about $10 billion. So not insubstantial, but in the first few weeks of this year, transactions actually rebounded. The
Interesting.
market got stronger throughout now this is obviously all of the Americas. So this is all of North and South America. So unpacking this data is right. Take it for what it's worth, but
Okay.
it shows something. I would imagine that disproportionately this is North America,
Sure.
because that really represents, like, size wise, a
Yep.
huge chunk of the market, probably more than half,
Oh, I'm sure.
at least more than half. Yeah. So you see the transaction volume was actually up this
Mhm.
year
Yeah.
so far. And in Europe, you see it's actually was a little bit down versus the past few years.
Okay.
So it was starting off to be a very strong year in transactions. I think that a lot of people who had been expecting a recession decided that there wasn't going to be a recession after all,
Mhm.
and they jumped back into the markets. So that's
Mm.
why I think this 2019 number was actually off, because people were getting a little more conservative. Now it was, hey, we're going to throw caution to the winds. There's no recession coming. We're
Interesting.
going to jump in. But this is the interesting graph, because this
Exactly.
is what happened in Asia Pacific, and where the COVID crisis hit
Yep.
sooner, right?
Yes.
So obviously it was well underway in China, and it was making inroads into Korea and Japan and Taiwan
For sure.
uh, during this period. And what you see here is basically a snapshot of this is where we're going, right? So
Exactly.
you can see that volume is off by, looks like, about half,
Mhm.
right, through through the first 11 weeks of the COVID crisis. So whether it spikes up again after the COVID crisis passes in Asia, if it passes through there more quickly, I don't know. We'll see what happens. In Japan was late in responding
Mhm.
to COVID. They thought that they could handle it with just trying to track cases and
Mhm.
crack down a little bit on gatherings, which was completely ineffective. People just ignored it.
Mhm.
I was seeing my Facebook friends from Japan posting pictures of their drinking parties with their
Mhm.
friends, just like normal. So
Right.
the government has finally had to now move to a lockdown situation in major cities, because it's about to explode and get out of hand.
Yeah.
So Japan is obviously a huge, it's the third largest economy in the world after the U.S. and China. Um,
Mm.
So if Japan is not back to business,
Right.
you'll see this number still continue to be flat. But anyway, this is just a snapshot. If you look at this data, you'll think, oh, America is doing fine transactions wise, but this data really basically ends. And this flattening up here, I'm not sure, but this could be the very beginning
Mm-hmm.
of when COVID started getting taken more seriously here.
Yeah.
So I expect that you're going to see this volume number dropping.
Yeah. So when I look at this chart, what I see is without a doubt, there's an impact, right? Deals stop. I mean, just look at Asia.
Yeah.
But I think what's going to happen when you kind of fast forward this 11 or, the next 11 weeks is I think deal volume goes up. So that orange line I guess that's orange. Yeah, whatever. Orange for Asia will go up. But what's going to be unsaid there is there's going to be repricing. Right.
This is just transaction volume.
Correct.
Well, that'll be interesting to see though, because what I think will happen in the market is that the repricing won't happen that fast. It's just like we were talking about before we started the recording.
Yeah.
The sellers are going to continue to have the expectations of 2000, basically of February 2020 pricing.
Right.
Like that's what they're locked into in their minds. And unless they are in a situation in which they have to sell,
mm-hmm.
it's going to be much easier for them just to pull their deals off the market and hope that things are going to return. And what I think will happen is that you're going to see from the kind of seller side of the transaction, mm-hmm. you're going to see a lot of sellers and brokers saying, oh, all of the government support programs haven't kicked in yet. Really, people have just started filing their claims, or they haven't been getting that $600 a week from the feds yet. As soon as that kicks in, everyone's going to be paying their rent. It's all going to be hunky dory. Mm-hmm. And then, in the summertime, everyone goes back to work and it'll just be back where we were. That's what the sellers are going to say. The buyers are going to say, I'm not so sure. Right. And so what you're going to see is a lot. I think you're going to have the transactions go down because it's going to be harder for there to be a meeting of the minds between buyers and sellers, because I think the rose is probably, the bloom is off the rose for the
yep.
buyers,
yep.
but it's still like really sweet and fragrant in the sellers' minds, because they've built this expectation of how much they're going to get paid. And I saw this happen the last time around. I saw this having gotten into the market right after the collapse in 2011.
Okay.
What you were seeing was a lot of properties that were really overpriced on the market. And over the course of, I think 2011 was really that kind of capitulation year, mm-hmm. where the sellers started to get realistic about what they were going to get for these properties. And you started seeing price cuts until the prices made sense for right. the buyer's risk appetite. So I think we're going to see something like this. And the longer this goes on, the more likely this is to happen. I think the one scenario in which this doesn't happen is if somehow like all the social distancing really works well, mm-hmm. and the COVID crisis ends much earlier than anybody thought, mm-hmm. and people are back to work. But even in that situation, I don't know if you were aware of this, just listening to a story on the radio yesterday, mm-hmm. about Wuhan in China, where they lifted the restrictions yesterday.
Yeah.
And they said, only about 60% of people were back at work, even having lifted the restrictions. And all the restrictions on large gatherings and gyms, mm-hmm. and things like that were still in place, because they know that there are still a lot of asymptomatic people walking around. Mm. So there could be another, if they're not careful, there could be another respike, right? So, and in Korea, we've actually already seen this, that Korea thought it had it under control. They loosened restrictions. They started letting foreign exchange students come back to Korea, yeah. from other countries, and now they're seeing another spike. So I think we're in for a few more weeks of this at least, and then the longer it goes on, the worse this gets. And here in New York City, we're seeing stuff like Broadway is dead and starting to refund money, and even if the Broadway actors are able to collect unemployment and they can pay their rents, there's those millions and millions of dollars of
Yep.
revenue for Broadway plays that are lost forever because you can't get those days back,
Yep.
right? And
Yeah.
and unemployment benefits are obviously not as high as what people make, for a living. So you're just going to see a lot less economic activity, and that's going to affect the economy. So I think that it's unrealistic to be optimistic that we're going to have a quick bounce back, and I think that's going to affect the multifamily pricing for sure. It's just going to make the buyers more risk averse, and
Oh,
they're
for
going to
sure.
and
Yeah.
they're going to demand higher risk premiums in the form of higher cap rates.
Yep.
And
It has to happen.
I think it's just human psychology is going to take over.
Yeah.
So
The thing I like about
go
this
ahead.
chart is these are, to use your words, meeting of the minds, right? The seller and the buyer have to agree. And right now, I think there is absolutely a chasm. And again, right before we started recording, I wrote 7 offers on Tuesday, which is not something I've done since 2010, which was the year I was most active in residential. And I didn't write these offers to necessarily get yes answers today, but I wanted the sellers to know what I thought their properties were worth for cash. And they were at least 30% below asking price, because I think we're going there, right? The lending market for non-clean properties is
Yes.
vanished. And thus I'm going to want an extra sweet discount because I do have the cash. So I think you're right. I think it'll happen in multifamily. There's probably a delayed time frame, just the numbers are bigger and all of that. But yeah, I'm writing offers on rough, vacant single family homes right now because
and it may be better in single family actually in terms of getting transactions done, because there are a lot more people out there in the world who have
exactly.
100,000 in cash that they can just say, hey, here's $100,000. I can wire it to you tomorrow, if you do the deal. And there's a lot of people like that out there. Whereas in multifamily deals, even for the wealthiest people out there, like $5,000 in actual cash, right? That's sitting in a bank somewhere is not that easy to come by, right? I mean, it's usually invested in something else, which means you have to sell.
Correct.
And if they are selling, unless they're doing it very strategically right now for tax reasons, if they're say selling stuff in the stock market that they've just taken a loss on, right? That's that's a hard thing. They may not want to realize those losses, especially if they believe that there's going to be a bounce back in the stock market or what have you. So, and it's certainly going to be hard to sell other properties right now to raise cash. So unless they literally have that money sitting in a bank account someplace, it's going to be harder to come up with $5-7 million in cash. So I think it'll take a little. The banks are going to have to start loosening up a little bit for that to happen. And right now, as we've talked about before, private lending is dead. All the private lenders are scared, so they're just in a wait and see attitude. CMBS is dead. That's commercial mortgage-backed securities. They're dead because the whole CMBS market is, for people who don't understand that market, it's when they take a bunch of mortgages, they package them up into a financial product that then they sell onto the next investor. And right now, that secondary market is dead. Nobody's buying nobody's buying this paper. So the originators can't lend because they can't sell it. And so that market's dead, which leaves only the government, the quasi-government agencies. And so they're still lending, but they have, drastically increased their requirements to get deals across the door.
Exactly.
Across the threshold. So, they have raised their debt service coverage requirements from 1.2 or 1.25 to 1.3 or 1.4. They're requiring huge reserves, unprecedented reserves, a year of debt service in cash, in escrow at closing, a year or more, up to 18 months actually, of your other reserves, so insurance reserves. And so basically, only the most well-positioned, strongest cash-rich investors who were willing to go after, they're going to be going after strategic assets that, this presents an opportunity to buy, or it's to the extent that that distress. I don't think there's a lot of distress that's starting to cycle through the market yet. It's just so
it's too
early.
Yeah.
But there's always some, right? There's always some in any cycle. There's always people who mismanage properties.
Sure.
So there's always some, but you're not going to see a wave of that quite yet. So I think the transaction volume is going to go down, and that kind of leads to something. So it's another article which came up this morning, which I want to show people, also from Real Capital Analytics. And by the way, this is they do paid research, obviously, but you can subscribe to their email newsletter, and there's a lot of great information in it. So
cool.
You should definitely do that, and it doesn't cost you anything. So this is an article. This is interesting because this is an analyst who said, "Hey, what has been the impact of COVID on pricing in in transactions, or has value fallen?" And he said, "Well, look, the REITs have fallen by 22%, but there's no perceptible change in transaction prices." And obviously that's because REITs are very liquid. You can trade REITs very easily.
Sure.
So price changes are reflected much faster. But also I think what's happening in the multifamily market is there are deals that were already in the pipeline that are now closing. So the prices haven't changed, right? And it's too early to tell if pricing is really changing. So he says, well, what would it take for there to be a 22% drop in asset prices?
Oh, interesting.
In the real world, as opposed to just in the REITs.
Okay.
And so he put together this chart, which is very interesting, and just shows you, well, the combination of net operating income and cap rate increases.
Oh, wow.
What would it take to have a 22% decline in prices? And so right now, 5.5 is the average apartment cap rate in February 2020.
Okay.
And now, again, a caveat here is I don't know exactly what they're counting here, because this is institutional focused, right? And it's also nationwide. So they don't define what their cap rates are, but this is basically the average. What they're claiming is the average cap rate for all apartments, probably over a certain size. I'd imagine it's probably 50 units or higher, or 100 units or higher.
50 or 100, yeah.
And it's including places like, New York City, where the cap rates are 3%.
Right.
And it's also including some other markets where the cap rates are higher. So this is an average. All right?
That's fair.
And so the range that this guy constructed was up to 7.1, which was the cap rate, again, nationally for every kind of asset in every market. I mean, I'm still talking about apartment buildings.
Yeah.
This was the peak cap rate at the height of the financial crisis. Right?
Okay. So that's the floor, if you will.
Yeah. Wow. So this is how far he went.
Okay.
And he said, well, how much, what would you, if cap rates just go back to where they were at the height of the financial crisis, what impact would that? And look,
zero.
There doesn't have to be any change in net operating income at all.
Yeah.
If prices just go back to where they were at the bottom of the financial crisis. And this is what I've been saying for the last 2 years at least, which is that if there is a recession, cap rates are going to rise, right?
Correct.
And NOI is going to fall. So, all you have to do is say, well, if people have not been underwriting, at least as a worst case scenario, where cap rates are or were at the height of the last, or as the trough of the last financial crisis, if they didn't underwrite to this number, in one of their scenarios, they were committing malpractice, as far as I'm concerned, right? So, because this is the number that they should at least be saying, what happens if this happens? Because this has happened in the past.
Yeah, it's a known. It's a known, right?
It's a known. Yes, this has happened in the past. And what I'm going to tell you in a minute, as we go through this article, is that this is actually a very optimistic number.
God!
He'll explain why.
No.
But so zero is all it took to get here if you go back to 7.1, right?
Understood.
I mean, if we just go up by, now everyone always underwrites to it's a 5-year hold. I'm going to do 10 basis points per year, right? He didn't do 5, he did it in chunks of 2, but let's go to 6.1,
Okay.
right? To get, if you just go down by, 4%, right? It's not much.
Yeah.
4% at a 6.1, at 6 basis points of cap rate decompression,
Yeah.
right? You've lost 16% value of the asset. Now, if you're trying to refinance
Yeah.
and you're down 16%,
Done.
what happens to you, right? This is now 16% of equity
Yeah.
that you have to come up with. And also, I think what a lot of people don't realize too is that on refis, you don't get the same proceeds you get as on a purchase money, right?
Nope.
So you may be able to get 75 or even 80% when you purchase.
Yeah.
On a refi, you're only going to get 70 max, right? So, so this number, now you're talking about, tack on another 5% to this.
Sure.
Because, and if you didn't, maybe you did some principal payoff, you can kind of make up that 5%. If you did an IO loan,
no,
like so many people are doing now to get deals done,
yeah.
you don't have that. You haven't built up that equity cushion, right? So you're talking, you tack on your 5% to this, you're talking about contributing 20% additional equity to the deal to get refinanced, right? At the proceeds you need to pay back your original debt.
Ouch.
And so you're going to all of your investors and saying, okay, you just, you put 50,000 into this deal. I need another 10 from you right now. Oh, by the way, and it's a recession and your stock portfolio has just tanked and maybe you're even out of work. So this is why buying at the top of the market and overpaying, is not such a great idea because this is what happens. So let's go through some of the other interesting things.
Well, hold on a second.
You have a question. Yeah,
I have a question. So I get the cap rates, I see them going up by at least 1% easily. Even if we come out of this somewhat this year, right? They're going to go up.
Yeah.
But the NOI one is the one, because I don't play with that number a lot. So let's just assume we had 100 units and they were all $1,000 for easy math, right? So when full, it's $100,000 a month, right?
Mm-hmm.
Let's assume normal vacancies. Let's assume February vacancies, which was the best time ever, was 5. So now you have 95, and they're all paying. Let's assume nobody didn't pay.
Right.
But now we're in April. You have the same 5 that were empty, but now you have 10% that aren't paying. So your economic occupancy goes from 95 to 85.
Mm-hmm. That
$10,000 that's missing, that all rolls to the bottom line, right?
Exactly. Like unless you've cut staff or something.
Okay. So maybe
you've made up a little bit, but probably, I mean, listen, what their apartments are usually not run with a lot of extra staff that they don't need, right?
But maybe you squeeze a little bit out of that, but not much.
Maybe, or, if to the extent you have people who are working hourly, right? Maybe they're not working as much. You might not have like your leasing people, maybe they're home because nobody's leasing apartments, right? So maybe there's a little bit of savings, but basically you're talking about a difference in your example of $10,000. You're not going to save $10,000 in salary, right?
So that would be an 8% roughly negative hit to NOI.
Yeah, let's say, I mean, so let's just figure out the math. If you're running at a 50% expense ratio, right? And so you've got 95,000 normally that you're collecting every month.
Correct. Yep.
And now you're down to
85.
Now you're down to 85. If you were at, let's just make the numbers easy. Let's just say it's 100% full and everybody's paying. Okay. This makes the math easier, right? So, and we'll just go down the same percent. So basically you've got, originally in your original example, you've got 100,000 per month that people are paying. You've got 50,000 in expense before your debt service, right? So 50,000 is your NOI, right? If you can assume that your debt service is going to be in like half of your NOI at least, right? If you're doing it right, it could be more if you're overpaying, but if you're paying like the way that I want to do deals, you're looking at a 50% expense ratio and then another 25% for debt service, leaving 25% for everything else.
Okay.
So that's CapEx, that's distributions, right?
Sure.
and you also building up any reserves you want to build up.
Okay.
So, you were at, making 50,000 NOI. If you've got those 10% of people who are not paying, now you're down to 40,000 of NOI, right? So your NOI before, so now instead of clearing 25K after your debt service, you're clearing 15K, right? Now, maybe that doesn't sound so bad, but once you start, but you've got CapEx, which is below the line, right? So you're paying, there's always some CapEx you're paying every month, right? You want to make some distributions. Basically, the distributions, it's coming out of the distributions first.
Yeah, of course.
So if, and you want to be smart and have some reserves, because you don't know what's coming, right? But the other thing is that now you've got, let's say you go to, I probably need to get a calculator to do this. If you were, so you may have, you may still be making your debt service coverage ratio in that example.
Yeah.
If you had, if you were basically at 50,000 a month in NOI and 25K, you're that's a 2.0 debt service coverage ratio.
Yeah.
You're doing okay.
Yeah. But what's the impact? What's the impact to NOI of just losing 10% of economic occupancy? How does that roughly roll through? Is that a 20% hit or?
Well, so you're down from, it's a 20% hit. Yeah.
Wow.
It's a 20% hit to your NOI. Right. And
so
then you're down. So you're down here, right?
Yeah.
If you lose 10% economic vacancy means that you're down here on NOI, which means that cap rate has to go up for you to be losing 22% in the market. I mean, in market value, the cap rate only has to go up by 20 basis points.
Yeah, that's what I was thinking. Because again, I think cap rates go to 6.5 again, using the whole national average, apartments over 100 units, blah, blah. And again, a 10% hit. Yeah. That's a third. Oh,
yeah.
Ouch.
So look, I mean, and if you're back up to just where we were at the bottom of the last financial crisis, with 10% increase, or sorry, 10% decrease in NOI, you're now at 40% loss of value, right?
I'm so glad I sold my apartments.
Which means you're underwater. Now, listen, I don't know if it's going to, with all the government support, who knows, but 10%, like, it's not a huge.
No, it's not.
It's not a huge thing, right?
No.
So if you bought at the top of the market, you locked in 10-year fixed rate debt, right? You may be able to ride this out because you don't have to sell and you don't have to refinance.
Right? But yeah, that's a big assumption. Yeah.
But if you did a bridge loan, let's say you did a 3-year bridge loan, right? And you're down 10% NOI over your projection, right? And you've had a tiny, you've had that, this is 40 basis points, right? I'm sorry, not 40 basis. Yeah, it's 40 basis.
40 basis,
so,
0.4,
yeah. So you're looking at 25% loss of value, right? When you go to refinance this property and take out that bridge lender.
Yep. No chance.
You may not be able to do it, and you may be handing the keys over to that bridge lender. So that's what I think the opportunity. I mean, I don't want to wish ill on anybody, but this is, in the next couple of years,
yes,
this is what's going to be shaking out. Right?
Yeah. This is why I think, kind of like we talked about earlier, I think residential shakes out earlier because you have a single asset, a single owner, life events, death, divorce, job transfer, all of that. Yeah. Where apartments, they have terms, right? Even if it's a 3-year bridge loan, right? And you're 6 months in, you can theoretically buy time and hope things get better.
I mean, here's the other thing too, right? I mean, that bridge lender may be faced with, 100 assets that are in the same situation.
True. Extended for 10,
Yeah, they may not want to foreclose. So they may be willing to just extend the terms until hopefully the economy recovers and they just ride it out. Right. But if that bridge lender, some of those bridge lenders are in the game of borrowing money to lend money, right? So they're just taking a spread and they're not doing it out of cash, like equity. They're doing it out of money they owe to somebody else.
Yep.
So if they can't extend their terms, or if they've worse, their loans have been called by financial institutions that they have to call those loans because otherwise they don't, they're in danger of losing their, whatever they lose if they don't have the right,
Yep.
what is it? I'm forgetting what, like
Collateral.
liquidity.
Yeah.
Yeah.
Liquidity.
The collateral, like liquidity, balances
Yep.
that they are required by law to maintain,
Yeah.
that they're going to have to call loans to make those,
For sure.
so that's where the ripple effects, it's all the debt. Like, if we lived in a society where we didn't have debt, then, we wouldn't have the booms that we have, but we also wouldn't have the, the crashes that we have. So, it's a double-edged sword, debt, right? It's great when things are going well, debt is great.
Yep.
And then if they're not well anymore, then it's a disaster, which is why sort of personally and professionally in terms of investing, you want to be very careful with debt, right? So people always look at debt as, well, look, I can juice my returns by using debt. And that's great as long as things are going well. And when they stop going well, it's the debt that kills people, not, if you were all equity in this deal, right?
Wouldn't matter.
Bought it for cash, you just ride this out, right? It doesn't matter to you. At a certain point, like, all you care about is, can you pay your property taxes? And
exactly. Property taxes, insurance. Yeah.
Yeah. And those things are such a small piece of your expense that, I mean, they're not insignificant, but I mean, they're big pieces. But if you got to the point where you only had to pay you got to go really far down to be at the point where you can't pay your taxes or your insurance. Right. So, there's a lot of room to triage before that, but the debt service.
Well, that's why one of the things I follow every day is, I call it cost of capital, but it really is, how easy is it to get money, right? How easy is it to get loans? And again, I obviously follow the residential side, but the same thing applies in multifamily, right? When prices are going up, debt actually gets easier until some point it doesn't get easier. And then we do this cycle again. And that's why I've been able to dance through raindrops the last 20 years and kind of sell at the right time and buy at the right time, because I'm watching how easy is it for folks to get loans. And I sell into that wave, and it's worked twice already.
And listen, we've talked about this numerous times before, but it's worth mentioning again, that there are people, if you try to do that, right, you try to sell when everybody's buying and buy when everybody's selling, you will get accused of trying to time the market. Oh, you can't time the market. You should. And the people who say that are always they're the permabulls.
Yeah, exactly.
Who, on some level, it makes them nervous when other people are selling, right? And publicly saying the market's getting too high. So they have it like a psychological incentive to keep on saying, it's great, it's great, it's great, it's great. You can't time the market. You're stupid. Nobody can time the market. But guys like you and me are not trying to time the market. No. Timing the market suggests that you are trying to make, like, exit at the absolute top and buy at the absolute bottom. And nobody can do that. That's true. No. So when you say you can't time the market, 100% agree. You cannot time the market perfectly, but you can absolutely. If your head is screwed on right, you can look at the market and say, now is a better time to be selling versus now is a better time to be buying.
Absolutely. Exactly.
And all you need to do to figure out which one it is to look at what other people are saying in the market. If everybody is saying it's the time to buy, then it's the time to sell. And if everybody's saying it's the time to sell, then it's the time to buy. It's really, really simple that way. Now, you may miss on some, you may sell a little too soon. You may buy a little too late. But chances of buying too late are probably very limited, because when everybody's out of the market, everybody's out of the market. You're not going to miss that moment if you have the cash, right? And being a little bit late is not. You're still going to be so early in the cycle. You're going to do fine.
Exactly.
It's really on the other end. And I saw an article a few months ago, and I have no idea how I can find this, but somebody did some analysis about whether it is better to sell. Which is worse, selling too soon and missing out, or missing the top and selling too late?
Right.
And emphatically, it is better to miss the last few bucks appreciation than it is to sell too late. Because if you miss the top, then you can't sell, and you got to ride it all the way down. Yeah. And what happens is typically people will then panic sell.
Totally.
And they lose money, right? So, or they're in a forced sale situation, right? Because economics changed. Now so you absolutely can time the market, and you should try to time the market, but you can't time it perfectly, and you shouldn't worry about that. You shouldn't kick yourself over, oh, I could have made another $100,000 if I had just waited 6 more months. Like that is a fool's errand.
Yeah.
What you should be thinking about is, yeah, I missed that other 100,000. Now the property is worth 200,000 than it was at the peak.
Exactly.
I captured that 100,000 of extra value, and now I've got it now to go and buy at the bottom and really make money. So,
yeah, I love using real examples. I talk about the first house. I think we've done it before, right? So I bought it for 107, sold it at like 263. It kept going all the way to 300. But the next time it retrades is after a foreclosure at 75.
Yeah.
I mean,
yeah.
And by the way, today it's worth 185. So it's not even worth 200 yet. So
yeah. Yeah. And you captured all of that.
Yep.
All that value for yourself by selling, right?
Yes.
And the other thing that people I think should remember is, like, you never make a mistake by taking a profit.
Exactly.
Right. You never make a mistake by taking a profit. Saying, oh, it could have had more profit if I waited. That's just, there's an old
wasted effort.
Yeah. Like there's these old adages about investing that have so much truth in them if you only pay attention to them. Like one of them is, bulls and bears make money and pigs get slaughtered. Right.
Exactly.
And it's like, that is, it's true of real estate just as it's true of the stock market. You have to take profits or profits disappear. If you don't take them, and people are like, oh, I can't take a profit because then I'm gonna have to pay taxes. Hey, it's better to pay 20% or whatever it is on capital gains tax on the appreciation rather than, lose 20% of the overall value. That's a bigger number,
sure.
Right?
Yeah,
so
I'm paying taxes for 2019 because of the apartments I sold last year.
Yeah.
Capital gains. I'm like, okay, that's fine. No big deal.
I mean, like having capital gains to pay is a good, like,
it's not, it's fine.
You want to be in that position of paying capital gains tax, right?
Yeah, exactly.
You made money, right? It means you made money.
Exactly.
So let's, before we run out of time, there's just a couple more things in this article I wanted to point out to people. So this is this guy, his name is Jim Costello. So Jim Costello is trying to figure out sort of what would create a 22% drop in value to reflect where the REITs are right now. But then he goes into some further analysis. This is actually where it really gets interesting. So he says that in the Great Financial Crisis, NOI only dropped about 4%, right? So we're down here in the Great Financial Crisis, right? But you had look at this. Cap rates dropped to 7.1, so there was 26% loss of value, right? But this is the first time that I've seen somebody in the official trade press talk about what I've been talking about for years. What he talks about is, I'm not sure where I can find it exactly. Oh, so here it is. Let's see. So here. So what he talks about in this paragraph is how this 4% drop, right, was the result of all those people getting foreclosed on who then moved into apartments, right? And I'm not sure, and this is overall, so I'm not sure the time frame, right? I think this is there could have been more or less at different times as people filtered in.
Fair.
But finally, somebody has said what I've been saying, that, oh God, where does he say it here? Oh, that basically, well, I can't find it, but read the article for yourself. He says that was a one-time event. All these people who bought homes and had no business buying homes, then got foreclosed on and had to move back into apartments where they were in the first place.
Yeah.
So there's no room for that to happen now.
Yeah.
Right?
Again,
this is not the number. Even in a normal recession, this is not the number because you're not having all those foreclosures again.
Exactly. And I saw that as an apartment owner and single family, right? It was a very unique environment where there were people who got housing loans that should have never qualified, that left apartments and then boomerang back. That is not 2020. And there it is. The normal recession is 15% fall in NOI.
Right. So here's the interesting thing, right? So then he goes, and for the first time that I've seen, somebody actually was like, hey, let's think about a previous recession before that unusual event of the Great Financial Crisis, right? Which was caused by a housing boom and bust, right?
Yep.
So he says, look, in the internet bust, in the .com bust, right? And that was a pretty mild recession.
Yeah.
apartment NOI fell 15%,
Ouch.
right? 15%. So you've got, if you're here at 14%,
Yep.
and you're back at 71, just back to this cap rate,
Yeah.
you're at 34%. So 1/3 of your value. So you're in negative equity territory now.
Yeah.
Most likely, right?
Absolutely.
And then here's the eye-popping one. In the 1980s, NOI fell a cumulative 42%.
Oh, shoot.
He doesn't even chart that here, right? He just only goes down to 22.
Oh my God.
So, you had, if you lost 42% cumulatively over the course of the 1980s,
Yeah.
your value, I mean, you were talking about property that was worth half of what it was.
Oh, easy. But at that level, it's so bad that nobody, it's all extended pretend at that point. Yeah.
So,
yeah.
And then the other thing that he says is, look, in the great financial crisis, right, one of the things that stabilized the multifamily market was that it was still easy to get debt for apartment properties.
That's true.
Right? So, but now, this is because of the chaos underway in the servicing of debt. And this is a really esoteric point, which is, even I was not familiar with this issue until very recently, and I still have a little trouble getting my head around it. But the servicers are actually responsible for paying the debt holders,
correct,
whether they get the money or not. And so there's a risk now that the whole servicing industry could basically go bankrupt.
Yeah, big weak link in the chain right now.
Yeah, and so if that, and there's going to have to be some kind of federal bailout for that.
No question.
Because otherwise the whole system is going to collapse. But that is, again, if every financial crisis is different. Last time they said, oh, mortgage-backed securities can't fail because there will never be, the whole pool will never default, or enough of them will never default. These are like, the most secure securities you can buy other than a treasury bill, because of math is what they said, right? Because all these homeowners are from different markets around the United States, are not correlated to each other.
Sounds very 08 to me.
Yeah, the default rate can never get to the point where the principal is in danger, right? And then what happened? They all defaulted at the same time. Yep. So here again, we have a piece of the system that nobody was paying attention to, which now is like has the potential for enormous chaos. And I think even if we're fortunate and this doesn't happen, this is going to change the lenders' risk attitude, right?
Yep.
So
which is going to impact cap rate. Yep.
It's going to impact how much cash is available to do deals.
Yep.
It's going to impact cap rates. So this, and the other thing that is sort of like hinted at here, which also helped keep the cap rate decompression from expanding too much, was that, when the financial crisis started, interest rates were like at 5.5%. And the federal funds rate, the federal funds rate was like at 5.5%. It then lowered all the way to zero.
Yep.
We were already at zero basically when this started. There's nowhere else for them to go. Yeah. So cap rates, so you can't, they can't sort of hold cap rates down by making it, by increasing decreasing the interest rate, which makes, there's a little bit of like chasing the interest rate down as people are bidding on deals. Yep. And that keeps the cap rate compressed. And at the top of the market, it really keeps it compressed. But now, that can't happen. Plus the spreads have grown. So the actual effective interest rates that you're getting as an investor are higher, so because the banks are saying, and they're factoring in like the servicing problem, being able to resell the debt, all that sort of stuff. They're pricing all that in, and they want higher spreads to compensate them for the risk. Yeah. So all of these things are going to contribute to higher cap rates, which means, so let's boil it down to a couple takeaways. If you got in relatively early, didn't overpay, and have long-term debt, you're probably fine.
You're fine.
Right? You're not going to make a lot of money. Your investors should not expect to get paid, but you're not going to lose the property, right? You can ride this out, and there will be good times again. Now, if you're a syndicator and you have cumulative preference obligations to your investors and you don't pay them for even a year, it is very, very difficult to catch up ever with that. So that means that if you're a syndicator, you may be living off asset management fees for a
A
while,
while. Yeah.
right? But you won't lose the property, and that's good. If you bought at the top, right now, you got to pray that the situation is better when you have to refinance, because
Yeah, that's your only hope.
you were in danger of potentially losing that property if this goes on for a long time.
Yep.
In the best case scenario, you're also in that, behind the pref situation,
Right.
where, you're not going to get paid other than asset management fees for a while.
Yeah.
And the other thing to remember is that, the way that deals are structured, at least should be structured, is that, when you sell the property, if you have preferred returns that are in arrears, it's going to come out of your cut then, because you've got to pay all the preferred returns. So if you're hoping on like, hey, I'm going to just ride this out for a few years and I'll make it up on the back end, there may not be a lot of back end for you, right? At the end.
Yeah.
The last takeaway is, if you're out of the market and you've been on the sidelines for a while, this may be the moment that you've been waiting for a long time, because there's going to be the pricing is going to improve. Now, it's going to take a while for all this to sort out. The banks are going to be very skittish. You're going to need to be really well financed and have good experienced people on your team, because that's what the banks are going to be looking at. They're going to be looking at the experience of the team and the financial wherewithal of the team.
Yeah.
But if you've got those two pieces in place, then there's going to be some nice bargains coming up in the next couple of years. So for those people, the key is get your ducks lined up now. So
yeah, my takeaway from this is, again, as a mainly residential guy, I could see multifamily easily falling 30% using these numbers, because I think the 7.1% cap rate that was hit last time is going to turn out to be low because of all the interest rate stuff we talked about below. I think NOI is going to fall double digits, probably around that 15 to 18% level. And yeah, I think there's good times ahead. They're probably 18 to 36 months out, I'm guessing. But yeah, this is going to be an interesting time. So,
and the other thing to keep in mind too is these numbers are averages, right?
Correct.
So now if you're looking at some of the markets that I follow, you've actually seen like C properties, it's 1970s properties have cap rate compression really almost down to this point. Like there's very little difference between A, B, and C,
right?
Last month, because everybody who's buying C properties was saying, oh, this is recession proof, or I'm going to reposition it into a higher level asset, right? So I'm willing to pay more now. The thing is, in some of those smaller markets, those cap rates are going to shoot way past the 7.1 number, right? Because there's going to be a lot more decompression in markets that, rightly or wrongly, are perceived as higher risk. In the smaller markets, I don't think, honestly, that it's necessarily economically justified, but it doesn't matter. That's not what drives cap rates. Cap rates are about perception of risk, and your institutional investors, your family office investors, the people who have a lot more to lose and are more sophisticated, are going to look at those smaller markets and be like,
not today.
It makes me feel very nervous.
Yeah.
So there's going to be a flight to safety, which means, flight to A properties that maybe not even are performing so well, but they're going to look at those properties and say, when we come out of this thing, this is going to be well positioned.
Right.
This is a new asset. There's very little deferred maintenance, all that kind of stuff. There's also going to be a flight to safety in terms of markets. So they're going to be going back to, the big markets, right?
Yep.
So if you're investing, as I do, in smaller markets, you're going to see even more cap rate decompression, which, as somebody who's buying, is going to be great. As somebody who's selling, it's going to be tough, choppy seas ahead.
Well, Jonathan, this has been a lot of fun. This has opened my eyes to what is coming. I really, really appreciate it. And I want to thank you for sharing with our audience.
Absolutely. Anytime. I love this. This is one of my favorite times of the week every week. So I look forward to it.
I appreciate that.